Today we're diving into a crucial topic for newbie real estate investors, and that is how to analyze a potential real estate investment, specifically focusing on a single-family rental home. Before jumping into any investment, it's vital to conduct a thorough analysis to ensure you're making a wise financial decision. So first, you're going to want to identify your investment goals. What are you trying to achieve? Are you looking to invest in a long-term rental property, a short-term rental? Is the property going to be a quick flip? For this video, we will analyze a property with the intent of being a long-term rental property. Second, you're going to want to research the local market trends, analyze the neighborhood's growth potential, property values, rental demand, and any upcoming development or infrastructure changes where the property is located. We will be looking at this single-family home in Savannah, Georgia. When analyzing the property, you're going to want to evaluate the property specifics. Now let's zoom into the property itself. We want to assess the condition of the single-family home, including its structural integrity, the age, repairs needed if any, and potential renovations that may need to be completed if you are not purchasing a turnkey property. Once you've found what you're looking for, you're going to want to crunch the numbers. Now it's time to get into the nitty-gritty. You're going to want to calculate the potential return on investment by factoring expenses such as property taxes, insurance, maintenance costs, and estimate the monthly rental income. To determine if this is a viable investment, we will be using BiggerPockets Rental Property Calculator. Now this property here is listed for $389,000. It is in Savannah, Georgia, zip code 31419. It's a 4-bedroom, 2-bath, 2,300 square feet single family home. Now for simplicity's sake, we'll be putting 20% down on this property. For this property, we will type in the property address, the correct number of bedrooms, bathrooms, square footage. The property was built in 1976, so it is an older home, but then we'll jump into the actual calculation. For this scenario, we will expect a little bit of a discount off the property price that's listed, and we're going to look at purchasing the property at $380,000. Next, we'll come across the purchase closing cost, and this is going to be $5,700, and typically the closing costs are 1% of the loan amount. Next, we're going to go into the loan details, and in this scenario, we are going to be putting down 20% with a current interest rate of 7.03%. Next, you'll have the points, and points are a fee or a charge from the lender, which you'll pay to take out the loan. 1 point is equal to 1% of the loan amount. This will vary by lender, but one origination point typically equals, again, 1% of the mortgage loan amount. If you are borrowing, say, $300,000 and your lender charges a 1.5 originating points, you'll pay $4,500 to your lender for originating that loan. Next, we'll come to the loan terms field here, and this is going to be a standard 30-year loan. Next, we'll move to the rental income field. Here, we will estimate the gross monthly rental income the property will generate, also known as the rental rate. They have a nifty tool here that pulls the comps for you. However, your most accurate rental analysis will come from a professional property manager within the area. Next, you'll have the annual income growth. This is a percentage increase year over year. You can expect the rent to increase for your rental property. We can conservatively estimate that rents will increase 3% year over year. Some years it can be much more than that, in other years it may be less than that. Next, we'll have your property taxes. We'll put here $3,773. You can pull this information from the public records found on the county's property appraiser website where the home is located, or you can ask your realtor about the current tax bill, and depending on your preferred search platform, they will display it on the listing as well. Keep in mind though, when you do purchase a property, they will reassess the property tax bill, and your bill will likely be higher the following year. Next, we'll have the homeowner's insurance, and in this field, we will put $1,634. Next, we'll want to calculate repairs and maintenance expenses. I like to use 1 point times the monthly rental rate for the year, which means if the property is grossing, say, $2,000 a month, we times times that by 1.5, which equals $3,000 for the year and is roughly 12% of the monthly rental rate. Next, we have the vacancy rate. The rate is the cost of the property sitting empty due to tenant turnover. Typically, vacancy rates are between 3% to 10% of the gross monthly rental rate, but again, that can vary depending on the area. Here, we will do 5%. We also have to expect for any major repairs, which are our capital expenditures or CapEx, and they are bigger projects and less than frequent improvements that will need to be done to the property, such as roofs, driveway, siding, or possibly new appliances. Allocating between 5 to 15% is good. However, this home looks to be in pretty good condition, even though it is older. It does look well cared for, so we'll put 3% here. Lastly, we have the management fee, which is typically 8 to 10% of the monthly rental rate, depending on the area, of course. But then we have the electric, gas, water and sewer, and HOA dues, if any. This one does not. However, the tenant will take care of typically the electric, water, sewage on their behalf. Understanding financing options is crucial. Explore and shop mortgage rates, loan terms, and evaluate how they'll affect the investment's profitability. Now let's finish the analysis, and we'll click this here. So this property here actually does not perform very well. As you can see from the report generated, it has a negative cash flow. So you're going to want to mitigate risk. Obviously, this property here does not cash flow and would not be a good investment. However, don't overlook the risk involved altogether. Consider the vacancy rate, market fluctuations, and definitely include professional property management services into your calculations. And having an expert manage your property is a huge way to mitigate potential losses and stress and truly make your property passive income. For this one, you don't have to worry because it's not a good sound cash flowing property. Analyzing a potential real estate investment property demands attention to detail and thorough research. Remember, a well-informed decision can pave the way for a successful investment journey. That's all today for this video. If you found this helpful, don't forget to hit the like button, subscribe for more insight to real estate investing. And until next time, cheers.